Rick, I'd like to start our discussion today with a topic that is somewhat academic, but I think we would be doing a small disservice to precious metal investors if we didn't start our discussion here today, and that is by paying homage to a Nobel Prize in Economics that was awarded recently this week to Ben Bernanke for his work on information asymmetry in finance, and his view that uh, there was a need to support financial institutions, to bail out financial institutions, even if they were failing because of their own gambles, in order to prevent a 1930s style of recession. Now, in his defense, if I look at what's happened this year, a typical 60-40 portfolio, which is a conservative asset allocation type of strategy, has had its third worst year in the last 100 years. The last time it performed this dismally was 1974, and the time before that was during the Great Depression. Now, I do see the headlines becoming progressively gloomier, but when I look outside my window, I don't necessarily see visible signs of distress on the street yet. So I have two questions for you. One is the timing of the award. We're going through this period of time where the Fed's credibility is being called into question for what they've done with monetary policy over the last decade and a half. And they're essentially being rewarded for that right now. And the second question is, we've seen trillions of dollars vanish from asset classes over the last year, but we haven't seen visible signs of distress yet. Do you see any merit in what Bernanke's thesis was and his corresponding Nobel Prize for it?
I certainly think that Bernanke retaught us the lesson that Hayek taught us from a different point of view, which is to say that there's a lot of ruin left in a society as great as the United States. I think Bernanke got a Nobel Prize because of his service to a certain school of thought around the sanctity of the state and the preeminence of big thinkers over ordinary humans. I think that Mr. Bernanke's ideas are popular around many classes of people. Popular around large financial institutions because to err is human, to profit from it is divine. And certainly he allowed those big institutions to profit despite catastrophic mistakes. Popular too around big government, because the idea that the central bank should run the economy rather than the market run the economy is, of course, comfortable to people who exercise the levers of power. Unfortunately, from my point of view, it's also very popular among the voters who prefer, I think, not to take responsibility for their financial future, but rather to consign that responsibility to Congress and Social Security. Mistakes, from my point of view. There are people, yes, who are beginning to face strains in their household budget. $5 gasoline is less pleasant than $3 gasoline. But thus far, we aren't seeing, as an example, wholesale of repossession of cars. So while people are able to pay the gasoline or are struggling occasionally with the gasoline bills, they've managed to keep their cars. That all can change. I remember going through something very similar to this in the first half of the decade of the 70s. The narrative can change. I remember myself, ADITYA, I'm sorry for this long-winded answer, but I remember myself crystal clearly in 2006 seeing a billboard on the 405 freeway driving to the LA airport saying, borrow 125% of the value of your house. Bad credit, okay. Now, I'm not a real estate guy, but I remember thinking as a lender, I don't think that ends well. Housing was booming, prices were going up, loans were getting made. It was 2 years before my realization that the real estate finance industry was toast, and the time that toast became apparent, actually 2.5 years. What I know for myself is that I feel much more comfortable betting on probabilities where I believe that my answer is right, but my timing may be wrong, as opposed to things where timing is irrelevant because I think the answer is wrong. Investing in real estate securities at a point in time when, like collateralized mortgage obligations, was clearly wrong, at a time where the product generators were saying borrow 125% of the value of your home, bad credit, okay. But it took 2.5 or 3 years before that circumstance came to be realized. And I think that precious metals investors, and to a different degree, precious metals equities investors, need to bear that sort of dichotomy in mind.
Now, one of the things I've heard you say several times over the last 6 months, I think now, and you said it a few moments back, is that you actually don't believe that the Fed is raising rates to fight inflation as much as you think they're doing so to put themselves in a position where they can have some tools in their toolkit in the next downturn. Now, the normalization of rates is a healthy thing, and all gold investors and gold bugs have basically been pointing fingers at the Fed, telling them to do that for a long time. They're finally doing that. The question is, we've been through 10 years of yield suppression and 10 years of a wild monetary policy experiment. So in your view, as rates are being normalized, do you think something has to break?
With the caveat that I'm not an economist, I think the probability has to be yes. I think it was on our last discussion, ADITYA. I asked you to put yourself in the position of somebody managing a university endowment or a sovereign wealth fund. And you have followed the old 60% equity, 40% debt, sort of narrative for a while. And for 40 years of declining interest rates, that worked wonderfully well. Industry's cost of capital fell, so margins increased and equity prices increased. Nominal yields fell, so capitalized values of bonds increased. Now we turn it around. Now 40% of your assets are in midterm and long-term bonds. And it is crystal clear to you arithmetically that your current investment yields aren't enough to fulfill your obligations. And you can't go to the legislature or for other sources of income to top up the pension plan or the university endowment. And you can't maintain your contractual obligations with the yields that you're getting on the bonds. And worse, as you learned in Great Britain, when they marked down the capital value of the bonds, particularly for those institutions who lent long and funded it by borrowing short, the decreasing capital values put your pension plan upside down, underwater. Something has to happen. It doesn't have to happen immediately, but something has to happen. The other thing, ADITYA, that makes me think that arithmetically something might snap, and this honestly does keep me awake at night, the below investment grade debt, the corporate debt, the junk debt, but also the junk municipal debt. With regards to the junk corporate debt, these are very illiquid markets. And these are markets that are really mezzanine markets, meaning that somebody finances for 5 years with the anticipation of rolling over as opposed to repaying. If credit markets freeze, there's no rollover. But much more concern, so much of this paper is owned by ETFs. It's owned by retail yield chasers who don't understand the structure of the underlying assets. First of all, the truly junk nature of many of these credits, the refinancing risk, but in particular, the illiquidity risk. I think if we had a circumstance now where there was some crisis in confidence in corporate junk debt, and you began to have a situation where the trillions of dollars of high yield ETFs began to experience redemptions, while the ETFs are highly liquid, the underlying securities that they own are completely illiquid. And the idea that these ETFs would have a race to the exit, selling these bonds with no bidders, I think could cause real, true pandemonium. And it really makes me nervous.
It is strange that they are that they've got their foot on the accelerator as much as they have. The Fed seems willing to cause this pandemonium voluntarily. And I don't know whether it's optics, whether it's credibility, whether it's the elections. I don't know what's driving this extreme reversal. So there's something very strange happening in the background here.
Well, I do think that they had to appear to do something about inflation. I think in truth, given the masters that they serve, that they can't afford to do much, but they have to appear to do something. The Fed is obviously a political body, if nothing else. But in particular, if they were faced with a liquidity crisis that came from another direction, and there are plenty of candidates, you can't cut rates from zero. The very strength of the US dollar compared with the euro is that although the real yields in the United States are negative, they're nowhere near as negative as they are in Europe. So, I think this is testimony to the game that the Fed is caused to play, being a political body. And I think relative to other central authorities, I'm not saying they're doing a good job. I'm saying they're doing a relatively good job compared to their competitors who are doing a catastrophic job.
Yeah, and speaking of their competitors, they're all meeting as we speak somewhere in the world. And I guess one of the things I do find interesting about what's happening right now, and you talked about liquidity in unknown places drying up, and currencies, when you look at the euro, the yen, the pound, they're experiencing historic levels of weakness, but it's happening primarily in response in terms of time frame. It's happened over the same time when the Fed has started its tightening cycle. Do you think this is speculative money looking for higher yields, or do you actually think fundamental weaknesses are being exposed in these currencies as a result of higher yields in the US?
Yes and yes. I think if real money had a choice between deeply negative real yields in an economy like Europe that has even more structural flaws than the United States, the idea that you would get paid a better nominal yield, a better real yield in a stronger economy with more liquidity. Remember that the U.S. Treasury market is the deepest, the most liquid, and the most transparent securities market in the world. If you had a choice between a relatively stronger economy, which is to say the United States, relative to Europe, a much more liquid market, and higher nominal yields, it's pretty obvious that the big money is going to go from being deeply wounded to only being a little wounded. I had a very large investor tell me not too long ago, when I was asking him about losing 490 basis points a year in purchasing power, and he said neatly, losing 5% beats the hell out of losing 15 or 20. I understand what you're saying, and I like the relative attractiveness of U.S. one-year treasuries because I want to lose less.
Well, I guess we're looking at this. The question is being asked or posed at a time when the U.S. has $31 trillion of debt. And I get the whole prettiest mare in the slaughterhouse argument, but on a fundamental basis, there is a concern, or there should be a concern. The other side of it is that these folks can keep monetizing the debt indefinitely because of this advantage that they have. And I guess that's the question I'm trying to ask, because it will have an impact on gold investors.
I think gold investors need to ask themselves the question. I think gold investors need to ask themselves whether they would like to invest in a contingency based on arithmetic, or whether they'd like to invest based on narrative. For myself, I would always like to invest based on arithmetic. The arithmetic around long-term debt is not good. The arithmetic around the financial structure of the developed world, never mind frontier and emerging markets, with rising interest rates in an economy that's become addicted to cheap and easy credit, is not good. The idea that we're going to experience more, not less, volatility will unnerve more people. To be honest with you, ADITYA, when I look at the length and breadth of financial topics that you and I are dealing with, although I own a lot of gold, I hope the gold price goes down. Gold does well in a set of circumstances where people lose complete confidence in the maintenance of their purchasing power in fiat instruments. That changes our lifestyles. And my lifestyle's pretty good. I realize that is not an outlook that makes a gold speculator who wants his gold stocks to double in 60 days particularly comfortable, but I don't care. I'm talking about investing and or speculating, depending on the client's point of view, in a circumstance that I think is much more likely than not to occur because of arithmetic. It could be that I'm very wrong. It could be that investors and savers and voters around the world continue to believe what Franz Pick said and what Bernanke proved, which is to say there's a lot of ruin left in a country this great, and we can finance it for a very long time.
Yep.
I have nervousness with that. While I'm a long-term optimist, I think that the possibility of recreating the set of circumstances in a crisis in confidence and liquidity that gave us the 2008 illiquidity crash are very real and perhaps very proximal. I'm pretty sure I know what the policy response will be, which is to say wholesale quantitative easing. And I hope I'm wrong on every score. I just don't think I am.
Okay, well, I want to put a line on the first part of our discussion, and I want to remind people of something you've often said to me, is that it's important to think about the macro, but money is made on the micro. Yep. And I want to remind people that for folks that are real investors and even speculators, thinking about the individual companies in the micro is more important. And so I'd like to transition from a very big picture discussion that we've just had, and this is something that I heard you say in the discussion series that you've been hosting with Albert recently on alpha versus beta stocks, and you're talking about the majors. And there was something that you said in that discussion, and I've thought about that as well when I read Phil Fisher and all of these value investors. There is an idea of compounding that is inherent in wealth creation, which has worked for a lot of these people. And the dimension of time is very important in that equation of compounding. When I look at resource stocks, which is the stocks that I spend my days looking at, I see a tremendous amount of cyclicality related to the nature of the business, the nature of it being a very capital intensive business, but I also see a tremendous amount of volatility in these stocks over a period of time. And so my question to you is, does the idea of compounding apply to resource stocks?
Yes, but differently. As you point out, natural resource-based businesses are capital-intensive and cyclical. They don't work the same way that something like Clorox would work. Marty Whitman has done wonderful work on value investing in capital-intensive cyclical businesses, talking about buying peak cycle earnings at troughs, anticipating peak cycles. Most resource companies, with certain exceptions, I would suggest Exxon, Chevron, companies like that, the major integrated oil companies, are not companies that are conducive to owning for 20 or 30 years. Some of the big royalty companies may, in fact, ultimately exceed to that status. But for the most part, with natural resource-based businesses, you need to buy them when they're deeply out of favor. And then you need to hold them for the 5 or 6 year time frame, sometimes 7 year time frame. What happens is that most people lack the foresight and the courage to buy them when nobody else wants them. And almost everybody, once they've bought them, won't sell them at the peak because the very price performance that they've enjoyed justifies the narrative, particularly a narrative that challenged them early in their holding period. I've been challenged by both over 49 years in the market. I need to say that I never bought at the absolute bottom. I never sold at the absolute top. Of course, Bernard Baruch said that the only one who ever did that was a liar, that it didn't happen. But in fact, compounding in resource stocks is necessary in a different way. As an example, if you saw even an investment grade company that was very deeply in the investment cycle, so the financial returns weren't as good as one would hope, there was much less free cash flow as a consequence of the reinvesting of that cash flow in future income generating activities, you need to hang around until the benefit of those investments begins to pay. I remember at Freeport-McMoRan, when they were investing sort of $1 billion a year at Ertsberg and Grasberg in Indonesia, the financial results around the company being supported by Jarrett Canyon weren't great. You needed to be around when the cash at Grasberg went from being $1 billion a year in to being $2.5 billion a year out. And you must do it with the compounding complexity of cycles, which is to say that if the commodity company that you're in is enjoying 50 or 60% operating margins, you need to be very careful that the market doesn't work, that you don't increase supply and reduce demand enough that the prices collapse. So in some senses, I wouldn't say it's a more complex process than other forms of investing, but it's a very different process than other forms of investing. When I compare it to some of what Buffett has been able to do in terms of understanding the durability of consumer products brands, understanding the durable competitive advantage of a brand, understanding that advertising expensed investments are more tax efficient than amortized investments. What he's been able to do in topics that I think are extremely complex makes me think that perhaps mining is simpler than I give it credit for being. My product cycles are much more understandable than his, although I, like him, am challenged by time frame.
The one thing that makes this very speculative based on my observation is the influence of commodity prices over time on what is happening with, you talked about earnings. I sent you the share price chart of Newmont to illustrate my point, is that from 1998, and this excludes everything about what was actually happening under the hood over that period of time, but there is a very predictable price cycle in these price charts as well when you look at cyclical sectors, and I guess there is a very strong influence of what the commodity price is doing. in terms of where the company is going to be in the next year, 2, 3, 4 years. So
Yes.
I guess if you're thinking about compounding, you're thinking about value, and you're thinking that value is accretive over the next 5 years. But if the commodity price is going south, as we're seeing with gold right now, it seems like it's taking away from accretive compounding. I don't know if you view it that way.
I don't. I think you're forced to deal with two factors. Next. What I think you do, or rather what I try to do in terms of commodity price forecasting, ex precious metals in industrial materials, as we've discussed before, I try to look for commodities that are priced at a discount to the cost of producing those commodities, where the price has to go up or we have to do without the commodity. Precious metals are more complex. I've come to believe over almost 50 years of being in precious metals that the most important determinant of precious metals prices is the saver's sense of maintenance of purchasing power of US dollars. So it's partly arithmetic, it's partly confidence. Confidence can change overnight. And you have to use the arithmetic to forecast the probability of that shift in confidence. If you were to assign probabilities to the sense that 2 or 3 years of experience with decreases in purchasing power associated with long-term treasuries and the impact that that might have on the willingness of people to accept treasuries, and then the probability of the fact that the Fed might have to go back into printing simply to finance government expenditures, you can assign yourself a possibility, perhaps a strong possibility, perhaps in my case, a probability that you'll see higher gold prices. You have to right-size the bet. In other words, if you think that those probabilities are contingencies worth insuring against, you need to consider how much insurance you can afford and how much time you want to own that policy for. I realize that that's not an answer that's acceptable to somebody who has a life and doesn't want to think through all this stuff. You know, so many times, I've had a couple occasions very recently in this classroom I'm doing with Albert Liu, where I read the comments below, and it says, enough already. Give me a stock that's going to go up. You know, I'm fine with all that. I understand that people are fragile. That's why they lose. But the truth is that, you know, you can't cater to someone else's or your own irrational expectations. All you can do is look at the circumstances around you, assess the probabilities, and allocate your capital to those probabilities that have the best potential to reward you in the time frame with the risk associated with it that's suitable to you. I realize that's long-winded, but it has the advantage or disadvantage, depending on your point of view, of being true.
As we're moving down in terms of granularity, we've talked about the world, the macroeconomic environment. We've talked about the sector and cyclicality and volatility at the level of a commodity and the sector itself. And the next question I have for you is around the Capex cycle. And I think one of the things you pointed out many times in the context of energy is that we've been through a long period of time of underinvestment from a capital perspective. And that typically sets up higher prices and more investment, which then leads to lower prices and less investment. But we're at this strange point in time where we have higher prices, but we have a lot of factors which are mitigating capital investment. And more importantly, I think we also have indicators that we're heading into a recession where you need less where there is less demand. And we saw OPEC doing its thing last week with cutting supply. So there seem to be a lot of mixed signals in terms of where we are in the investment cycle. Are we at the bottom of the investment cycle, or are we at the top of the investment cycle?
ADITYA, you're being a scientist again. You act as though there's an answer. There isn't. I think that you need to take all those factors into account. There is no doubt that the oil industry, as an example, has been underinvesting for a very long time. You're an example. The oil industry spent 20 years making you into a really good geophysicist, and then they let you leave. I mean, how dumb is that? But that's what happened. You have a circumstance now where, as you point out, the oil industry is enjoying record or near record free cash flows, but much of the industry isn't making even sustaining capital investments. It's estimated that the industry as a whole is underinvesting in new product and sustaining capital investments by $1 billion a day, $360 million a year. They're doing this for two reasons. One, the natural resource-based businesses, particularly in the decade 2000 to 2010, deployed capital very, very, very stupidly. Overpriced acquisitions, ill-fated capital expenditures. And so the institutional investors are keeping natural resource-based businesses on very short leases, given the sins that the industry committed a decade ago. The second thing with regards to the oil and gas industry is that while the politicians are asking for more production now, at the same time, they're telling the oil industry they're going to put them out of business in 2030. So asking Exxon to invest $30 or $35 billion a year, promising them that these will become stranded assets, is a mixed signal at best. For intelligent investors, this is a tailor-made circumstance. You have to do the work, but you look for companies that are generating substantial amounts of free cash, that are priced reasonably relative to that free cash, that are still making the sustaining capital investments and the new project investments necessary to maintain or increase production, while also treating shareholders fairly. The trade in oil stocks right now is simply that investors have turned into yield whores. They look for the companies with the most generous dividend, and they pay no attention to the sustainability of that dividend. This is like competing with a moron. The moron may outcompete you for 3 or 4 weeks because there's more morons and they bid dumb stocks up. But over time, competing with somebody who is buying companies that are cannibalizing capital because the yield is higher is the easiest thing on the planet to do.
And this is despite the flashing signals of a recession ahead of us.
I think a recession is a real fear. I frankly think it's a probability. And the reason, as an example, that I'm not rushing really headlong into the copper stocks, despite the fact that we're running into a copper supply cliff, is I think that you can take down supply and not have a meaningful impact on price if you take down demand too. I'm really cognizant of that. It's one reason why, as an investor, I continue to look at the extremely efficient companies, the low-cost producers. Earlier in my career, I looked for optionality, which is to say I looked for companies that had large resources, large reserves, but reserves that were marginally economic at current prices, because ironically, the least efficient companies get the best margin expansion when the prices go up. What happened to me there is twofold. Other people started looking at optionality, and rather than having those companies be dirt cheap, speculators started paying for that optionality. It's weird that you would pay for inefficiency, but that's what's happened. And as a consequence of the fact that I see recession as a probability rather than a possibility, the supply cliff that I see within 5 years makes me less greedy than it otherwise would, because I see the potential for a demand cliff too. Looking further out, ADITYA, the ascent of humankind makes me hugely bullish. around many, many, many things, but commodities among them. Consider, and I don't need to tell you, hailing from the subcontinent, consider that 1.2 billion people on Earth have no access to electricity. They want to live like you and I do. And the living standards that they've enjoyed in the last 40 years have increased measurably, will continue to increase. But as an investor, you need to get through 3 years before you can enjoy 10 years. And it wouldn't surprise me to see recession-induced malaise. Well, I think we're seeing a recession-induced malaise in natural resource stocks. If you look at the price of copper producers right now, relative to production profiles looking at 5 years, you think, my God, why isn't copper at X? Why are the copper stocks trailing at such insanely low levels of free cash flow? It's because the market is expressing a concern about the future direction of the economy and a concern about copper pricing.
Okay, Rick, we're getting closer to the end of the hour. And I would like to ask a more general question here. We're going through a very turbulent time right now. A lot of folks have gotten involved in the space over the last 2, 3, 4 years. And we're seeing an unnatural amount of volatility. It is not common to see a pandemic followed by a war, followed by historic rate hikes. And that's causing a huge amount of volatility in people's stocks and people's portfolios. Do you have any general words of wisdom, either in terms of psychologically dealing with this, or in terms of opportunities, and how you would advise people who are at an earlier stage in their investment career to think about opportunities, given?
I would argue that the volatility that we're seeing is completely natural. On the one hand, you're seeing stocks that are, in a historical and an absolute sense, cheap. You are seeing a world where, because of demographics and because of the ascent of humankind, demand for commodities is increasing, and increasing at a rapid rate. You're seeing a world, too, where concerns about security of supply, geopolitical concerns, are reawakening after 40 years. These are all very, very bullish things. Against that, you're seeing increases in interest rates, which raise the cost of capital in a capital-intensive business and lower the capitalized value of distributions, which is to say dividends. You're seeing geopolitical insecurity, and you have a recession looming. I'm surprised that the volatility isn't substantially higher than it is. I think that the somnolescence that we see in the market is a consequence of 40 years of very benign climate. I remember real turbulent markets in the 60s, the 70s, and the 80s. Markets that made this one, in terms of volatility, seem like absolute child's play. It's interesting that, as an example, if you're a gold speculator and the gold price goes from $1,000, which it did, to $1,900, which it did, and that upside move, fairly dramatic, is justification of your narrative. But if the price goes from 1,780 to 1,650, which it did, down, that's volatility. People don't seem concerned by upside volatility so much, ADITYA, which is interesting, because if they're buyers, downside volatility serves their interest. So I think what's necessary is for investors to do some sort of self-determination. Figure out, first of all, if they're attracted to alpha, that is, if they're speculators, or if they're attracted to beta, which is to say, if they're investors. Examine whether or not investing in volatile times, which are the best times to invest, are suitable to their psychological well-being, whether their psychological well-being is more important to them than their financial well-being. And I think, frankly, that for most investors, most people who have lives, they're concerned with their jobs, they're concerned with their kids, their grandkids, they're concerned with playing golf. They need somebody like you to help them be self-honest in terms of portfolio construction. If you have some sense, and you're never going to be right, ADITYA, if you have some sense of the value, or at least the range of values around an investment, if you have some sense of what you think a company's worth and what it might come to be worth, given the proper set of circumstances, the price fluctuations bother you less. I very recently did a private placement in a little royalty company. And I thought on market, the royalty company was selling for half what its liquidation value was. If you looked at a stock chart, it looked like the electrocardiogram of a corpse. There was no way that I could buy any stock. There was no way I could sell any stock. So I had to do a private placement. Otherwise, I couldn't get a position. While the stock didn't go down, it didn't go up either. I actually paid above market in a private placement for that stock. In my circumstance, because I had a sense of what the company was worth relative to what it's selling for, and because I had a sense of what their durable competitive advantage was, the volatility and the illiquidity in that circumstance worked in my personal favor. Investors need to come to understand themselves. They need to come to understand what investment or speculative facets are of use to them. They need to figure out psychologically and financially what risks they can take and how they will be impacted by volatility. I'm at this wonderful position in life where, because of psychology and because of my experience, because of my capital base, I get to use volatility. I don't get used by volatility.
Yep.
In a risk-off environment like the one that we're on, I always turn up the risk dial. If nobody's willing to write a risk check, I've made most of the money I've made my whole life writing risk checks. And I've always been luckiest when I was loneliest. My circumstance is different than the circumstance for many of the people that you have to deal with on a day-by-day basis. The problem, however, is theirs, not the markets.
Yep. So in summary, what you're saying is suck it up.
Yeah, or leave. Either are okay.